Biden White House just put out a framework on regulating crypto. Here's what's in it. The Biden White House has just released its first ever framework on what crypto regulation in the US should look like, including ways in which the financial services industry should evolve to make borderless transactions easier and how to crack down on fraud in the digital asset space. The new directive stepped the muzzle of existing regulators such as the Securities and Exchange Commission and the Commodity Futures Trading Commission, but nobody's mandating anything yet. The long-awaited direction from Washington has, however, captured the attention of both the crypto industry as a whole and of investors in this nascent asset class. The framework follows an executive order issued in March, in which President Joe Biden called on federal agencies to examine the risks and benefits of cryptocurrencies and issue official reports on their findings. For 6 months, government agencies have been working to develop their own frameworks and policy recommendations to address half a dozen priorities listed in the executive order: consumer and investor protection, promoting financial stability, countering illicit finance, U.S. leadership in the global financial system, and economic competitiveness, financial inclusion, and responsible innovation. Together, this recommendation comprise the first whole-of-government approach to regulating the industry. Brian Dees, director of the National Economic Council, and National Security Advisor Jake Sullivan said in a statement that the new guidelines are meant to position the country as a leader in governance of the digital asset ecosystem at home and abroad. Here are some of the key takeaways from the White House's new crypto framework. Fighting illicit finance. One section of the White House's new framework on crypto regulation focused on eliminating illegal activity in the industry, and the measures proposed appear to have real teeth. The President will evaluate whether to call upon Congress to amend the Bank Secrecy Act, anti-tip-off status, and laws against unlicensed money transmitting to apply explicitly to digital asset service providers, including digital asset exchange and non-fungible token (NFT) platform, according to a White House fact sheet. The President is also looking into whether to push Congress to raise the penalties for unlicensed money transmitting, as well as potentially amending certain federal statutes to allow the Department of Justice to prosecute digital asset crimes in any jurisdiction where a victim of those crimes is found. In terms of next step, Treasury will complete an illicit finance risk assessment on decentralized finance by the end of February 2023 and an assessment on non-fungible token by July 2023. Read the fact sheet. Crime is rife in the digital asset sector. More than $1 billion in crypto has been lost to fraud since the start of 2021, according to research from the Federal Trade Commission. Last month, the SEC said it charged 11 people for their roles in creating and promoting a fraudulent crypto pyramid and Ponzi scheme that raised more than $300 million from millions of retail investors worldwide, including in the United States. Meanwhile, in February, U.S. officials say $3.6 billion worth of Bitcoin, their biggest seizure of cryptocurrencies ever, relate to the 2016 hack of crypto exchange Bitfinex, a new kind of digital dollar. The framework also points to the potential for significant benefits from a U.S. central bank digital currency or CBDC, which you can think of as a digital form of the U.S. dollar. Right now, there are several different types of digital US dollar. Sitting in commercial bank accounts across the country are electronic US dollars, which are partially backed by reserve under a system known as fractional reserve banking. As the name implies, the bank holds in its reserve a fraction of the bank's deposit liabilities. Transferring this form of money from one bank to another or from one country to another operates on legacy financial rails. Thank you.